these big dinosaurs pulled the whole market up. And like Warren Buffett says, if the water in the sea goes back, you see who's wearing swim shorts and who not. So for this year, I would say focus on size, not on the style. So yeah, the sectors are also important. I will get into that too, but hold your eyes open for the small and mid caps. First things first, I want to go a little bit through some macro stuff. And because I watched a video with Julius de Campena, the inventor of the RRG, and Sam Stowell, more or less the creator of the sector rotation model, and what you also find on stock charts. And so I put a presentation together and I want to show you a little outlook for this year. This is a clarinet, and again, once a month I come up here on the daily brief and show you my Murat's monthly. So how I see the markets and where does the music play. So that's why there is a clarinet at the back. And first I want to go over this seasonal chart. This is the S&P in the red line, and then in the blue line you see the 10-year seasonality of the S&P. And I just recognized last year that the S&P was following this seasonal chart pretty well. So you see all up and downs were more or less predictable based on the 10-year seasonality of the S&P. And then one more thing we had last year is that we were in a pre-election year. So you can also screen the seasonal charts based on their based on specific cycles. And I also like cycles, and the presidential year is a cycle every 4 years. And so I pulled out the data over the last 25 years and looked how the S&P followed his seasonal pattern over these years. And it was also quite accurate, how you see on the chart. Again, here, the red line is the S&P and the blue line is the seasonal chart. Yeah, but even intraday, it was quite nice sometimes, but especially if you're a swing trader, that was a nice wind in your back, what you had with the seasonal patterns. I want to take a small outlook for this year, what we can expect. First, I want to start with to look a little bit back, because what happens after a good year and what happens after a bad year. And the thing is generally that we see after a down year that these years are followed by a positive year, so by an up year. And 2022 was quite bad and down. And so we could have expected that 2023 will be pretty good. And so also this pattern was right. And generally what you see if we have a down year, that we have the S&P gaining around about 20% over the year after it was bad. So, and then you've got also here some industries and sectors which are performing a little bit better or worse. And then if we have had a positive year, generally we can expect that the next year will also be good. Here is also a statistic where you see again that the best buying window is if you buy in November and hold it till April instead of buying in May and hold it till October. So you will outperform the market more if you stay in the market from November till April. So we are currently in this time horizon and time window. So if you have your stocks from the statistics, it would make sense to hold your assets until we get into April, March. And generally, when or most often we see or we saw market crashes around March. And I think 2008-9 was it in March, COVID was in March. And so if you look in the history, most of the crashes were in March or October, so that are quite weak months. Then what else is interesting? Again here the cycle. We are in the first term of Joe Biden, and we are now in the fourth quarter, so in the fourth year of his period. And what you see is that generally this fourth year performs pretty well in the S&P. What actually makes sense, what I also always try to do or look for is when I see a seasonality, is there a logic behind it? And of course, if we are looking at the presidential cycles and the election years where we are now, then it makes totally sense that the president is willing to give the people a good year so that he gets elected again. And so, like I said, it makes totally sense that we are performing in the S&P also pretty well, because if the stocks go up, I think in the US over 42% of the people have stocks or are invested in the stocks, where we have, for example, in Germany only around about 7 to 8%. And that is also because of the retirement programs and so on here in Germany and in the US. So that's why also why the S&P is so sensitive to news and so on and so forth, while it is in Germany too. But so the music is playing in the US, and that's why you've got more these herd moves, like when everybody is buying or selling, that you see it in the market. And we can statistically, if we look back to the World War II, the fourth period or the fourth year in the first period of the presidential term was always positive. And it is at the beginning of the year a little bit choppy, it goes up and down, but after the second half of the year, generally the market goes up. And so the question is, where should we be invested? Because we've got an environment of several thousand stocks. So where are the interesting ones? And currently we can say that based on the earnings per share growth, if we evaluate this and look in the historical data, we can see that actually the mid and small caps are the guys where the music plays, because measured on the earnings per share growth, we can see that these stocks, so like the mid and small caps, are currently, based on their average, I think it is a 20-year average, based on their average, they are undervalued by 15%. And compared to the S&P, so relative to the S&P, and that's what I like, relative charts. So relative to the S&P, the mid caps are currently undervalued by 30%. So we've got a lot of upside potential in the mid caps. This goes slightly up when we look at the small caps or micro caps, because there we have an undervaluation of 19% compared to itself or to its average. And if we compare it relatively to the S&P, they are undervalued by 34%. So we've got quite a lot upside potential in these small and mid caps. And if you screen the market, it would make maybe sense to look a little bit more into these stocks, because also, you probably know it, that the last year, I think 85 or 90% of the performance of the S&P came from the Magnificent Seven. So it was like Tesla, Microsoft, so on and so forth. And the rest 493 stocks made nearly no performance. And if you look onto equal weighted S&P, the performance was far not so good, like we had it in the market cap weighted S&P. And that is because these big dinosaurs pulled the whole market up. And like Warren Buffett says, if the water in the sea goes back, you see who's wearing swim shorts and who not. And so most of the stocks were not so good. It was just a few. So for this year, I would say focus on size, not on the style. So don't look, the sectors are also important. I will get into that too, but hold your eyes open for the small and mid caps. And that is also, like you maybe already know, you can visualize that also on the RRG. And here I throw up the Dow Jones large and small caps. And what you see here is that it doesn't depend if it is growth or value. It is more that and that is quite interesting, that normally growth and value are going in the opposite. So either we have value performing good or growth performing good. But what we have now is what you see here, that the small caps and mid caps are strong, and it doesn't matter if it is growth or value. And it doesn't matter if it is growth or value in the big caps that they are weak. And you see here the yellow ones. So I compare this. So this is based on the Dow Jones. So the Dow Jones index is my benchmark, what you see here on the right side. And then I compared all these under sectors of the Dow Jones, how, like you see here, separated by mid, small, small and large caps. I compared all these assets against the benchmark, and you see that these blue ones are all small, mid, small, mid, small, mid caps, which are performing pretty well. So they are building up momentum and moving to the right side here, while the big guys are weakening and moving to the bottom left.
Yeah, I see this everywhere. Like
Yeah.
one stock I really like right now is EMKR,
Hmm.
and this thing looks absolutely perfect, and it's 62 cents a share right now.
EMKR. Okay, I will have a look at that.
And they're a semiconductor play
Oh, okay, nice.
in the defense industry. And
I will have
yet,
a
if
look.
you look at something like Tesla, it looks like
Mhm.
absolute shit.
Yeah.
Huge key reversal last summer, and it just keeps working its way lower. And now I just noticed Intel actually is
Mhm.
putting in an outside downside key reversal just this
Oh,
week.
really nice. Okay.
So there's a perfect example. Two behemoths look like shit. Small
Mhm.
cap stocks actually look really sexy.
Yeah,
And
that's
this is
also
just
what.
one example, EMKR, but it's one that I noticed here recently. It just
Mhm.
looks absolutely perfect. But it's such a good analogy of what you're saying.